So in the hourly auction model, it's all about looking at how these hourly candles are reacting to the previous hourly candles, whether it's the first presented previous hourly candle or it's the other previous hourly candle. You can see these candle reactions and understand where the current hour may go and target that draw on liquidity for that current hour. Um, for this video, we're going to be going over the bearish candle reactions, looking for a sell continuation. Also, we want to acknowledge the best time to get continuation trades, usually when market volume or market volatility initially begins, which is usually around 8 p.m. or 8 a.m. or 9:30 a.m. This strategy works best when you're trading the continuation after the market makes its or forms its direction for the day. So entering when the initial breakout, initial volume spikes up will probably have a higher chance of getting you stopped out of these trades. So my strategy works best after that initial move and then trading the continuation. So around 9 a.m. or 10 a.m. or not 9 a.m. sorry, that's market open. 10 a.m. is a good time to trade the continuation of market open. When it comes to Asia session, 8 p.m. is usually when we have that initial volume spike, and then 9 and 10 p.m. are good times to trade the continuation of those volatile moves. So let's look at some bearish candle reactions here. We already went over the bullish candles. Now we're going to look at the bearish candle reactions. So the first bearish candle reaction here we have is a strong bearish candle with minimum retest. When the previous candle is extremely bearish, the new hourly candle may open and barely retest or not retest at all before continuing lower. So let's look at some examples of this. So what I like to do, honestly, is have my daily candle open on the left side now, and I'll have my hourly candle open on the right side. So I can see the direction of that daily candle. This is the biggest story. Well, it's the biggest story of the current day. You want to know what's going on in the current day, in the current hour, and in the current 5-minute time frame. And that's how we're going to get our direction, our target, and that's how we're going to get our entry. So direction is on a daily, our target forms from the hourly. What does this hour want to target? And then our entry is on the 5-minute. So bearish candle minimum retest. So let's look at an example of this. It does not have to necessarily be a bearish candle. A bearish candle can also form within a bearish wick. So if we look here on the daily, we have this bearish daily wick. What can we see here? We have bearish hourly candles. So looking at these hourly candles, we're going to go ahead and find a strong bearish hourly candle. We have this one right here. So why is this candle considered a strong bearish candle? We wicked at the top, we pushed price lower, and we closed price down here with little to no wick down here. There's a little bit of a wick. So what can we expect from the next hourly candle? When this candle opens, this is 10 p.m., perfect continuation. What are we expecting for this hour to do within this hourly candle? We're expecting it to retest this candle. We're expecting it to come into this candle, seek those sellers out, whether it's in the wick or the body, put in its top wick. What did we do here? We put in our top wick, and we're targeting something lower. What can we target lower? We have this low on the market. Okay, that's moving around a bit. We have the low after that, which we did end up taking all of it. And then we have, what did I do? Okay. And then we have this strong drawn liquidity lower right here. So this is the strongest drawn liquidity because there's a lot of buyers in this wick, showing that there's a lot of stop orders here. And price would most likely come to this level and reverse up higher. There's going to be natural movement after we take this wick. So we can target that wick and understand that we're probably not going to get a reversal until we take that wick. So looking at that strong bearish candle, waiting for the new candle to put in its wick within this candle, following daily structure. So why would we even be looking at shorts? We swept something on a daily time frame. Price did not break higher, did not close above the sweep. We pushed back lower, showing potential reversal. So now we have our daily bias. We're looking at that daily candle start to drop. What can we see on the hourly that is going to show us that it's going to drop? This bearish candle, this candle reacting to the previous bearish candle, we're most likely to react in the body or the wick of this candle, and we're waiting for this hourly to put in this top wick. We don't even want to go down a time frame until we see what we need to see in this current hour. So we're waiting for that top wick to be formed. We're not even going down a time frame. We're waiting for it to wick out and push lower, and then we're waiting for it to start flipping back lower. And so now from there, I can go to my 5-minute. Mark that candle out so we know exactly which one it is. So what am I looking for inside of this hourly candle? After we push down, we start flipping, and now I can scale down to my entry time frame. What am I looking for? I'm looking for us to inverse a price leg, a bullish price leg. I want to see something bearish happen. Where do we see an inverse price leg? Right here. These are all buyers. Buyers here, buyers here, buyers here. They're ultimately failing. So by the time we do flip down the time frame, that price leg is probably already inverse. What do we need to see? We need to see price close below these buyers, showing that they got completely wiped out. So there's buyers right here. There's multiple candles showing that there's buyers present, and we completely wiped them out. We closed below them right here. We ended up closing below the buyers. So that's where you get your entry, targeting your hourly drawn liquidity. Short position, stop is at the high. I should not revisit where the buyers tried to push price at. I like to widen my stops a little bit just in case we want to come sweep that high. And then we're targeting the liquidity. We're targeting that low. And if you held this trade, even when it came back up, I probably would have been break even by here. So that's why sometimes I take base hits. I'm just like targeting something like that. We have a low right here. I probably would have targeted that. I'm not gonna lie. But if you want to go for those bigger hits, say you see price start reversing down here and we closed and we inverse a bearish price leg, that's your cue to take your profit and get a possible re-entry if you see that hourly candle start to flip back lower to the next drawn liquidity. So you can hold your trade until it invalidates your idea. So if it's coming down, it's coming down. We're having a strong push past this drawn liquidity. We didn't really get any confirmations that this is going to reverse at this area. We're still pushing lower. Yeah, this wick would have probably scared me a little, but we ended up pushing lower. I would have held it just to see. If I don't see any inverse price legs, it's not showing me that buyers are stepping in. I'm holding it till that drawn liquidity. Now, what do we get here? A bullish candle on the 5-minute, a strong 5-minute close. And what can we do from there? Go ahead and take our position out, get a re-entry if we want to on another account because we took profit on this account. There's no reason we should still be trading the same account that we took this trade and closed out of. There's no reason, honestly. Take your profit and go. So if you get a possible re-entry for another account using the same strategy, same setup, what are we waiting for? Inverse price leg right here. Perfectly. These two bullish candles got completely inversed. We could take another entry on this to the same drawn liquidity that never got took. Now this stop is a little wide, so the RR isn't going to be too good. So I recommend targeting something lower. Breaking even at this area, having a decent RR, and take profit would have still been hit down here. So it is okay to get re-entries if you have multiple accounts, but if you end up taking profit before your profit target, there's nothing wrong with that when you see your trade starts getting invalidated instead of waiting for it to come all the way back up to break even. So what did we do? We saw the direction on daily. We saw the hourly flip and react to the previous bearish candle, strong bearish close. I did not mean to click that. Strong bearish close, minimum retest. We barely retested that candle because of how strong the sellers were on the hourly. Go back right here. Minimum retest. We barely came up high. We didn't even come up to the wick up here. We barely retested this candle and we just completely dropped from there. From there, we could have seeked out our bearish entries using our hourly to find profit targets. What were our profit targets? This wick low right here, strong liquidity zone, Um, and honestly, these equal lows were amazing as well. And it actually got hit. So these were all profit targets. When it comes to putting my take profit, I like to put it a little bit before the actual profit target. So I probably would have targeted like somewhere up here to play it safe. But this was a great trade, honestly. I probably took these shorts. But this was a great trade. So what is the next counter reaction? Bearish wick retest and then continuation. So when the previous candle leaves a strong upper wick, the new hourly candle may retrace up to that wick and then reject lower. So we're gonna identify that in the market. Let's erase everything. On the hourly time frame. Let me go ahead and look for that. Okay. Boom, right here. So we have these hourly bearish candles, and we actually retested bearish wicks multiple times. Here we have a bearish wick. So when this 11 o'clock candle opened, 11 a.m., what can we expect from this candle when it, you know, comes up into this area? What can we expect? Stumbling over my words again. But we have a bearish wick right here. We have a bearish body right here. So we're looking for this candle to react off of either one of these levels. And you can be in a trade, have your stop above that wick, and automatically assume that that next candle is going to react to the previous wick of this bearish candle. So you're going to be safe until it hits your, drawn liquidity. And what could we have targeted? The middle of this wick. So yes, this was a draw liquidity, but price is likely to react in the middle of this wick before it goes all the way down here. That's called consequent encroachment of a wick, or it acts like a fair value gap. So playing it safe, targeting the middle of this wick, which it did hit, and then it reversed back up, took previous day high, and then it dropped. So targeting the safe zone where price is probably going to reverse when your take profit gets hit. And for that counter reaction, what did this do? This candle came up into this previous candle, put in its top wick, and then it pushed lower. So we're not even going down to our lower time frame until it puts its top wick and then flips and go lower. Same thing for this candle, this 11 o'clock candle, this is 12 p.m., this 11 a.m. candle, same thing. We have a wick right here. It tapped that wick. What are we looking for? For it to leave its top wick and push lower. Once we start pushing lower and it looks very dramatic and it's displacing, now we can go down to those low time frames. See a 5-minute inverse price leg. Let's see. Right here. Let me mark those candles out so I can know which one it was. Okay, yeah. In this box, we're looking for a 5-minute inverse price leg. Perfect. Targeting that next draw on liquidity. We have a 5-minute inverse price leg, and obviously you're targeting whatever the high time frames tell you. You're not taking every single hourly counter reaction if it doesn't look good at the time, but if you do see a good setup and a good target, that's when you take a trade. What do we see right here? This bullish candle get completely inversed. So a price leg does not have to be multiple candles every single time. A price leg could be one, bullish candle get completely wiped out. And on the low time frame, it is a reverse or inverse price leg. See, this bullish movement got completely inversed and then closed below. So then that would be a entry to take shorts where we closed. Stop is at the previous high. And what are we targeting? Something lower. We have this low right here on the 1 minute. Price ultimately came and hit TP without even coming this high up. So looking for those inverse price legs on the 5 minute. You can even scale down to the 1 minute. Rarely, but sometimes you can even scale down to the 30-second. So looking for that inverse price leg after that counter reaction. So reacting, we have counter reactions either in the body or the wick. And that was a wick reaction. We had 2 wick reactions here. and we're waiting for that candle to flip. So how do we know if it's going to flip within that wick or that body? We're just waiting. That's all you gotta do is wait. Um, Sometimes you'll see like a little bit of a push down when we do tap the body or somewhere in the wick. You want to see it like push down. You want to see like displacement. You want to see it actually like put in its top wick, push down, and you're like, all right, that's not coming back up there. And that's when you flip down the time frame. All right, what's next? Bearish consolidation break window. When the previous candle is bearish, price may consolidate in a tight range during the new hour before breaking the low and continuing the trend. Let's see an example of this. So whenever we talk about consolidation, that's usually our dojis. You can see a doji here, which shows indecision in the market. So even though we did retest that body in the wick of the previous candle, if we go down to the lower time frame, in that same area, it could just be consolidation. It could just be consolidation. So being careful for those doji candles or those candles that show selling pressure. Yes, it could continue through, which it did. It continued through this next candle if your stop was at this high. Ultimately, so this trade would have still hit take profit, but these doji candles that form like this, they usually end up being consolidation on the lower time frame or showing indecision in the market. And that's all that mean. And sometimes they still play through. If you just hold your trade idea, they still play through. Bearish pullback with a deeper retest. Also, let's go back to the consolidation and breaking the low. So with these dojis, if you see this candle here and you're trading this candle here, you see we react to the top of this area. We don't break above it, but you see this is displacing lower, and this was a bearish, bearish range. All these candles were bearish. You can automatically assume that we're probably going to displace through this candle wick, through this bottom wick. So if you see a doji and you see the next candle open, you can look at those previous candles to understand or determine the direction of the market. We reacted in this bearish wick. We started displacing through the body. You can see the candle start to drop. So now I scale down to my 5-minute inverse price leg, and I'm targeting liquidity lower on that lower time frame. All right. Bearish pullback with a deeper retest. After a bearish candle, price may pull deeper into a premium or supply zone, sweep liquidity, and then reverse back down. So let's find an example of this. I should just start back testing these reactions and then just showing you guys which reaction is which. I think that's gonna be like my next video. A deeper retest. Price has been very bullish on gold right now, so that's kind of hard to find. Actually, this counter reaction is beautiful here. So this is a extremely strong bearish candle. This is showing that there's a lot of sellers right here. So if this price doesn't push down, or this price like doesn't push down, this candle doesn't push down, this candle doesn't push down, we got a deeper retest into this bearish candle. We could even come up to this wick, and we did get that deeper retest, and we're entering on that candle that finally flips. This candle finally left its top wick and flipped. The stop would have been at the high of this candle, looking on the lower time frame for an inverse price leg, and then you can see it just dropped. So waiting for those reactions within the body of these candles, and if you don't see it, don't take a trade. And that's the art of being patient and waiting for those perfect entries, perfect trades. Let's see another example of this, if we could find one. So in the body, it's not really a deep retracement here, but in the body of this bearish candle, and yes, we can react off of previous candles. We don't have to necessarily go off of the first previous candle. So we can get reaction off of these candles as well. So we see that we came to this bearish body. We came above this candle, but what do we still have before it? A bearish candle. We came into this bearish candle. We put in our top wick on this hourly, and then we started dropping, and we had, somewhat of a deeper retracement, even though it's at 50% or equilibrium of this candle. We had somewhat of a deeper retracement into this candle, and then we finally put in our top wick and then flipped. So then when we see this start rejecting, we can now go down to our 5-minute stop, would probably be somewhere at this high. Not expecting price to come back up to that top wick, looking at the daily time frame for direction and confirmation, not just taking any wick trade, not taking any hourly candle trade. You want to have some type of story from the high time frame already set in stone. But if we had a bearish story, this candle would have been a good confirmation. This was at 1 o'clock p.m. We had a bearish candle here. We put in our top wick into the bearish candle. And then we started flipping lower and displacing lower. So we could have targeted something lower. I probably would have targeted the bottom of this wick, which did ultimately get hit. If my stop was at this high and I held my trade, it did end up getting hit. All right, bearish inside price expand. The new hourly candle opens inside the range of the previous candle, creating inside price, then breaks out in the direction of the trend. Okay. Here. Let me find an example. This is a pretty good example. We have a strong bearish candle here. This is a minimum to no retest right here as well. But we did open within this bearish candle. Little to no retest, like I said, left its top wick. I think we already used this as an example. Left its top wick into this candle and then dropped a little lower. What could we have targeted? I do see a lot of buyers stepped in here. A lot of buyers stepped in here. So I don't have a clear target for this. I probably wouldn't even be taking shorts at the time. Let's see another example. This is a good example here as well. These bearish candles. We have a bearish body, a bearish wick. We're holding this bearish structure here. We did not close above it. So also looking at that market structure, you could learn about market structure in the previous video. We did not close above this price level showing bearish structure. We have a wick, a body, a down wick, a bearish candle, a bearish body. So we're expecting that new hour to react off of the previous bearish candle, which we did. We put in our top wick. Once we saw we started, displacing lower, pushing lower, we could have entered a trade here and then targeted something lower, which just completely wiped out all the sellers down here. I mean, all the buyers down here, and then flew up. But this candle opened within this previous candle, and it just kept doing that. Honestly, these were all pretty good short setups. We put in our top wick and within this candle and then push lower. We put in our top wick within this candle and then push lower. Same thing here. We put in our top wick within this candle and then push lower. So we're waiting for those flips. Like we're waiting for the candle to put in this top wick in a bearish candle or in a bearish candle wick, flip lower, displace, and then you switch down to see that inverse price leg and then trade to the next draw liquidity. And so this literally just kept playing out back to back to back to back. And how do we know that we're changing trend or we're having some type of reversal? We took that liquidity and we start displacing through the previous bearish candle, which happened beautifully here. We displaced, and now that's when you start trading the bullish candle reactions. Wick in this bullish candle, a flip higher. Wick in this bullish candle, this is a deep retest because we came into the base of this candle. We still held it, and then we flipped up higher, putting in this bottom wick. Same thing, and that's when we start trading bullish candle reactions. So that is all for the bearish candle reaction video. I feel like I could have explained this better. I don't know. I might remake this video, but do let me know if you have any questions. Just come to me directly and I'll kind of, reiterate it or make it make more sense if that makes sense. If this was a good explanation. But yes, these are the bearish counter reactions for continuation. These are good continuation moves. It's a good continuation confluence strategy. All of these counter reactions are mostly for continuation. You can also use it for reversal and to trade continuation from the reversal. So this is the STS certain trade strategy, hourly counter reactions. And this is what makes up the hourly auction model.